The income event and the expense event are two of our most basic events. The income event is used to model revenue coming in. It's quite common to use that with a bank and downstream expenses. Similarly, the expense event can be used to model both one-time, ongoing, but also amortized expenses, where we take a value and spread it over a period of time. Let's dig in further. Starting with an income event, the most basic implementation allows you to set a frequency, an amount, start dates and end dates, and in this event here we're also applying inflation. The inflation for a scenario can be set in the scenario's parameters. Here the inflation is 1.9%. You can open that up and change that parameter as you see fit, and that gets applied to your entire scenario. So here we're seeing the $50,000 a month spread across time here on the start date, but you will see that monthly it is increasing by that inflation amount. You can also use an income event to model a one-time occurrence. So here we're using the frequency to be one time, and we're setting to be $85,000 in the date of that one-time income. Note you can also use a contract event for much more fine-grained one-time expenses and income. So here you're seeing we recalculate that one-time $85,000 in income. Now let's take a look at expenses. A basic expense, much like an income, allows you to set the cadence, the amount. You can target which particular sub-account of expenses you'd like this to be allocated towards, either the top-level expenses or any of the sub-accounts within that. You can apply a start date, an end date, and also inflation. So here you can see under expenses, those quarterly expenses, or you can look at cash flow to see that impact on your cash flow, both monthly and or cumulatively. Next up, let's take a look at an amortized expense. So here you can take a single value, set the payment frequency and the amortization period, and we'll calculate for you what that amortization will be over that period of time there and apply that to your scenario. So here, if we bypass that back on, you'll see the expense, $25,000 spread over that period of time, and its impact on your cash flow. Note that the majority of these scenarios can also be modeled with a debit-credit event. Debit-credit allows you to do more accounting-style income and expense calculations, very similar to what you can do with both the income and the expense event. So for example here, you can see an expense at the same time, modeled out over time here with the start date and end date, and how it looks in cash flow. So that is the income event, the expense event, and showing how you can perform similar calculations with a debit-credit event.